Is the bubble about to pop? That's the big question. And let's have a look at that today. September, a month to remember. Great start, right? So let's have a look here. There are some things that I want to talk through today, and in fact, again, highlight how challenging and confusing it can be to try to navigate markets, and also offer a solution of how it can be pretty much simple, rules-based, data-based, statistical edge, not opinions. Let's have a look. Look, for example, S&P, I mean, it's just crazy. We're close to all-time high. Like, we know that the labor statistics in the US have been cooked. They removed 1 million of jobs, more or less. Also, like, the massive deficit government spending is propping up the economy, and that's unsustainable. You have just like tons of issues that are surfacing more and more and more. But because the Fed has now shifted away from inflation and more towards supporting the labor market, people expect rate cuts this month, obviously, and the first ones, and generally that would be an environment to bring liquidity, more liquidity back into the market. Now, and that would mean more liquidity means there's more money to buy into risky assets, stocks being one of them, crypto anyway. And that's sort of the thing, like while the stock market is closed, the weekend, cryptos are not. And we have a bit of a foreshadowing. You've seen like Bitcoin dropped even lower, and more, let's just say blue chip, but still higher risk assets like Solana are trading at a very, like at their basically multi-month low support levels here. So technically, the crypto market is foreshadowing weakness. Now, it hasn't broken necessarily, but all in all, I mean, this structure is not completely bullish here, right? We're looking at the daily of Bitcoin, so there's room to 54 easily, and wicks like that do like to get filled. So from that perspective, it's not necessarily a bullish, let's just say sign. Now we need to wait for the stock markets, and I wanted to go through this thread here. So John says like why he believes the SPY will top at the end of October. And he said he traded both the dot-com boom in 2000 and the great financial crisis in 2008. And I see parallels of today's S&P with the 99-2000 mania because of the whole, back then it was the new market, all these internet companies popping up left and right. And like today, there wasn't really money making with any internet companies possible just yet. But that's why you have these bubbles. Like they invest in literally everything that says internet, and some of them become the Amazons, the Googles, And today is the same. Like you don't know exactly which AI is gonna, at the end of the day, make a win. But that's why tons of money is flowing into that. What I do see now is an eerie similarity to the third quarter of 2007. I'll begin with the 06 to 09 SPY chart. So you can also see here that October 2007, we had the market top, right? And then in September 08, you had the big drop. So that's what he is trying to look at as a fractal. So there was a bottom in August 15th, 07, followed by a rally of 5% into the rate cut pivot. What we're going to see probably this month as well. In September 1807, the first rate cut in 4 years. You see, a little bit, very much similar. So as they say, history doesn't repeat, but it rhymes. Why? Because people and like human behavior, it's cyclical and it's still more or less, I wouldn't say exactly the same, but actually it rhymes. You can see here in 07, September 18, the SPY rallied and then topped, and then adding another 2.6%. So we rally into the rate cut. And then in September 07, you can see here also that how the indicators, the economic leading indicators began to fall significantly. And we see that also in the US. Like we don't have really that right now, I mean, that positive of economic data that would give us confidence in the current economy other than being propped up by government spending. That's, by the way, something that was not the case yet in 07 and definitely not in 2000, that governments were so completely out of touch with how much they're spending. The 2-year and 10-year yield curve inverted 420 days before the SPY peaked on September 10th, 07. Current inversion, 2 years and 10 years, over 820 days, the longest, and it has flattened near Friday, 2 year. So what's the point about that? You have to think about it. When the cost of credit for long-term and short term becomes more or less, or there's not a difference there, then people are not very confident about the long-term future, right? That's why they want to go more short-term, and that's a negative sign. This is what the inversion was playing, and then the re-inversion back is basically has always been followed by a recession in the past. So that's also something that we cannot just ignore. So with delinquency rate on consumer loans, so basically people are defaulting on their loans, and also the level of how many people are in debt in the US is just insane. Inflation coming off prior highs, consumer loan delinquency rates began to escalate in the third quarter of 2007 as well. So again, a similarity. Commercial loan mortgage-backed securities, that was more or less what broke the back in '08, because everyone and his mother was getting a loan for a house for free. By the way, I just read, I'm not sure if it's true, that in the US, supposedly, illegal immigrants are supposed to get loans for houses for like $150,000. Like, I'm not sure if that's true, man. That would be literally the demise, and they're destroying the economy. Like, I don't know why they're doing that. But anyway, so they started to climb rapidly, over $1 trillion, set to mature higher rates by the end of this year. What it means is that when you have old credit at a lower rate, and then it needs to be rolled over, but now obviously it's more expensive, then, you know, it just takes away. This is why tightening, or basically increasing of interest rates, needs to work itself through the system. So when loans mature, you need to take new credit, roll over your credit basically, but at a higher rate, so that will take away from your liquidity, or maybe even from your ability to pay it in the first place. That's also a reason why a lot of people didn't sell houses, because they even the more money they would be getting for the higher prices of the houses, the higher financing costs wouldn't allow them to buy anything else or to do anything proper with that money. The current divergence SPY price and the conference board, the unprecedented. So basically, you know, the conference board is saying like, damn, everything's bad, and the price going up. So we had this K-shape also thing happening after COVID. So essentially, Wall Street went up, but Main Street went down. What it means is that typical people struggled since COVID a lot more, while everyone that owns asset or was rich already went up through the moon. And this is a little bit the same. So while the prices of the companies are going high, the confidence and the economic data isn't, okay? So that's a divergence. Usually a divergence is like a scissor. When it goes out, at some point it snaps back. And this is what you want to be paying attention to. So the present state of the overall euphoria in the S&P measured in aggregate is at levels exceeding all prior tops since the 2000 mania. So you can argue all you want about the reasons of why, and I would say most of it is government spending, but nonetheless, you cannot ignore that we are stretched, okay? But again, like I said in my other video, Peter Lynch, right? Like, far more money has been lost preparing for crashes than in the actual crashes. So I'm not someone that is going to look to where to short here. But also, I would be, you know, starting to think about, okay, what is a cheap way to hedge myself? Maybe, you know, take some powder to the side to keep it dry, like Warren Buffett has been doing. So none of these ideas are bad ideas, I would say. Calling the exact tops in the S&P, oh, I love that. It's a fool's errand. This is exactly what I just said. A top isn't known until a 20% drop on closing basis. Hence, my firm belief that the SPI will make a top before the election that will hold well into 2026. Wow. History does rhyme, and recency bias is a profit killer. So recency bias is also something that's very, it's a fallacy of a lot of people. Just because something has been the way it is, it doesn't mean it will continue to be like that. There's absolutely no statistical evidence for that. You know, it's the same way the other way around. I also mentioned that in another video the other day, is that when you're playing, for example, roulette, and you had black, and now you'd say, now red must come, like red must come, right? Because it was black. But that's not true. There's absolutely no evidence for that this would be happening statistically. It continues to be random. The distribution is random. And this is also what you can call being lucky or unlucky to catch a certain type of distribution. So that's why time in the market beats timing the market, especially when you have assets that are generally of high quality that you want to be in for a long term. So I think this is a really, really good post. And then people just come with tons of other ideas here. The M2 is decreasing, which is the liquidity, basically. Dump money is in full bull mode. So what I'm trying to show here is that, like some other guys said, like, hey, you got to look at '07 in Japan, the economy, blah, 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 blah. So from that perspective, you could endlessly go into these things and debate them until, you're 100 years old. So it becomes extremely theoretical. Now, what I take away from that is that technically we're stretched. I'm a bit more cautious, but at the same time, the trend is your friend. So don't fight the trend. Very simple. That's really what I'm looking for. And in the meantime, and this is why I am the statistical edge guy, the fundamentals are extremely tricky. It's good to understand them and to add them as a layer in your decision making, but you need to have also systematic systems because they are a money printing machine in the meantime. And I can show you that here. So for example, this is my track record account. In August, we made 7.04% on the month. We recovered fully from what we had lost in July, the first drawdown in many, many, many months. So now we have a consistent track record that goes over 1 year, almost like few more months. And then we have 2 years here with over 100% profit. And this is rules based. And I don't really care what fundamentals do because the price or the chart and the way I'm looking at the chart from a statistical edge basis, and I use my building blocks concepts in terms of bringing the statistical edge on my side, gives me the edge that I need to play out in a market. So this week, I'm looking for pound Aussie, for example. I still need a bit more of confirmation here for it to turn around. I'm also looking at my alpha trend indicator to turn bullish here. That could be an interesting trade that I'm having my eyes on for this week. Another one is actually euro dollar because it break down quite strongly. I wanted to come back to the 111 here, and if we see a weakness there, and then this structure can, basically is more confirmed for me, then I'm looking to basically sell it down to that support here, 109, where, by the way, I would expect it to bounce back up. So on the weekly, because on the weekly we have a bullish structure, on the daily we have a bearish structure, on the 4 hour we have a bearish structure. So this is not a 10 out of 10 type of setup, so I will manage my risk accordingly. I will not take a bigger risk here, but maybe a smaller risk. And if the trade goes in my direction after I open it, I will manage the trade more closely, meaning my risk management, my trade management actually in that sense, will be more tight because that trade is a bit more of a risky setup than a clear 10 out of 10 setup. So this is how you gauge your setups and make sure that it is incorporated in every decision that you make, and also that you have a clear plan when you're going to do what, when, how, and all that plan is based on statistics before and rules, and this is how you build a track record like that. And if you're interested to learn how I do all of that, I'll mentor just a few people a month actually. I just want to thank also everybody who left like positive reviews here. Finally, we're picking up here some speed also with people that are really happy with how we are teaching them exactly these concepts so that you can build a strategy that works for you, that fits your lifestyle, that fits your personality, that is based on a statistical edge. You learn the building blocks concepts, and you're not, you just don't, the market is the market. It goes up, it goes down, it goes sideways, but you know when you're going to do what, and you know your edge and how you're going to make money. Thank you very much for watching. Please like, subscribe, share it with your friend, your mother, whoever, if you like this content. I'd really like to bring that algorithm to jump up even more so that we can share more of this information with more people. Again, thank you very much, and I'll see you in the next video. Bye-bye.